Let's get more on this now with Nour Eldeen Al Hammoury in Dubai. He's Chief Market Strategist at Equiti Group. Welcome back to the program, Nour. Now, let's start with the US. Employers added 130,000 jobs in January. How much does that report reduce odds for interest rate cuts by the Federal Reserve?
Good morning, and thank you for having me. It definitely reduces the urgency for the Fed to cut, but it doesn't kill cuts yet. But it pushes at least the timing out. 130,000 gain with unemployment at 4.3% reinforces the Fed base case. Stay on hold until inflation progress is clearer. Market basically also reacted in a textbook way. Yields are up initially, also dollar strength, and risk asset spread a little easier. That's basically the market saying no panic cuts needed. On the recession side, this report also weakens the immediate recession narrative, of course, but it doesn't also ease the slowing down story, because we've also had major downward revisions to prior hiring trends. So here, the less recession, and it is more like a late cycle, as growth basically is slowing but not collapsing.
Right, and we have a strong labour market alongside weak consumer data. Is the market essentially celebrating the headline number while ignoring the cracks in the real economy?
I mean, the market is not definitely ignoring the cracks. It is basically repricing the mix. The labor market is still providing a floor, but the consumer is showing fatigue. Retail sales have been flat, and sentiment has basically softened, which tells you households are becoming more selective. Fewer big tickets purchases, more sensitivity to prices. We'll have to watch, of course, for the composition, and a good headline for the jobs number can also coexist with weaker spending. If the job gains are concentrated in fewer pockets and real income momentum, as the momentum slows, this is basically how you get a market that rallies on payrolls and still keeps a defensive tone under the surface.
Now, looking at equities, tech and AI-related stocks are back up. So what's driving this rebound following the large sell-off that we saw last week?
I think we have like two drivers, positioning and technical. Last week's sell-off was sharp and narrative-driven. Fear the new AI capabilities could basically pressure traditional software pricing models, and that created an oversold setup. Second, the money flows rotated back, especially from retail investors who stepped in aggressively after the dip, which is something that we've seen over the past couple of months. Also, in addition to that, this isn't a one AI trade markets or one AI market anymore. It is splitting into AI hardware winners versus software uncertainty. Semis and infrastructure will still attract capital because AI is fundamentally capex heavy, while software is where investors are debating disruption risk. So the rebound is, I think it's real, but leadership is narrowing, and that matters for how sustainable it will be.
Nour Eldeen Al Hammoury, Chief Market Strategist at Equiti Group. Great to have your thoughts. Thank you.